received feedback suggesting that our analysis of the loss of purchasing power is distorted due to the economic data preferred by the news media. Our business is rooted in lending to assets, particularly commercial real estate. We are bridge lenders who lend our own money, not that of investors. Many asset-based lenders operate under the guise of being the actual source of funds, but we genuinely have our own skin in the game. If we miscalculate the leverage against an asset, we risk losing our own money, not the money of depositors, investors, or government guarantors. Our perspective is shaped by the need for accuracy in asset valuation, because our survival depends on it. In times when price stability was reliable, appraisals were sufficient to determine market value. However, the current practice of debt monetization has dramatically altered this reality. Among our peers in the lending industry, the primary hesitation in funding loans stems from the inability to rely on appraisals for accurate market values. Today, most bridge lenders lend on a cost to acquisition of no more than 60%, whereby the borrower is required to bring 40% to the table. Over the past year, we have experienced 2 instances where we believed our equity position was so secure that losing money seemed impossible. In both cases, we were proven wrong. Despite having a loan-to-cost value of less than 50%, one asset sold at foreclosure for 25% of the appraised value, and another for just 15%. These experiences underscore that market values are largely driven by the cost of debt. When debt is cheap, values are high, and vice versa. The manipulation of asset values is a long-standing tactic used by the elite to consolidate wealth. If debt costs were to return to 2.5%, property values would soar, creating an illusion of wisdom among asset holders. However, this would not reflect increased productivity or solutions to housing shortages. Instead, it would highlight the erosion of currency purchasing power. Current asset values are inflated by debt monetization, and rental returns are often less than 3% after costs. The sustainability of these values relies on maintaining cheap money through continued debt monetization, creating illusory value. For example, an asset costing $550,000 at 2.5% interest has a holding cost of $2,173.16, whereas at the current rate of 7.2%, the holding cost is $3,733.34. Finding a tenant who can absorb a 72% increase in holding costs is unlikely. The commercial real estate market faces dual pressures: higher refinance costs and tenants unable to bear these costs. In some cases, asset values have fallen below production costs. The relentless debt monetization has led us to a critical point. Without further erosion of purchasing power, all classes, including the elite, will face the consequences they have imposed on others. When earnings are decoupled from purchasing power, debt becomes the only mechanism sustaining economic value. This unsustainable reliance on debt will eventually lead to severe repercussions for everyone. The elite will soon realize the futility of holding unproductive assets in a market that no longer exists.